Welcome to Chapter 7, CAPM and APT. Chapter 6 showed us that diversification can reduce firm-specific risk. This chapter asks the natural next question: if some risk can be diversified away, which risk should investors actually expect to be paid for bearing? The capital asset pricing model gives a very clean answer. Expected return depends on systematic risk, measured by beta. Beta asks how strongly an asset tends to move with the market portfolio, not simply how volatile the asset is by itself. Two stocks can have the same total volatility and still have very different betas. One might be driven mostly by company-specific surprises. The other might rise and fall with the economy, interest rates, and investor risk appetite. CAPM says those are not the same economic risk. This chapter connects the market portfolio, the capital market line, the security market line, beta, alpha, index model regression, multi-factor models, and arbitrage pricing theory. Those terms can sound like a convention of finance acronyms, so we will keep returning to the decision behind them. What return is reasonable for the risk being added to a diversified portfolio? CAPM is intentionally simple. Its assumptions are strong. Its market portfolio is difficult to observe perfectly, and real returns are influenced by more than one factor. Yet, the model remains useful because it creates a disciplined benchmark. It forces the analyst to separate expected return from wishful thinking and systematic risk from noise. Think of CAPM as a map, not a promise. A map can be simplified and still stop us from driving into the ocean. By the end of the chapter, you should be able to calculate a required return, interpret expected alpha, explain what beta does and does not measure, and decide when a multi-factor model may provide a better description of risk. This chapter has 4 practical learning objectives. First, you should be able to explain the logic linking expected return to beta. Under CAPM, investors hold the market portfolio of risky assets and adjust total risk by combining it with borrowing or lending at the risk-free rate. In equilibrium, an asset earns a larger expected risk premium only when it contributes more systematic risk to that diversified portfolio. Second, you should be able to interpret the capital market line, the security market line, beta, and alpha. The capital market line applies to efficient, complete portfolios and uses total standard deviation on the horizontal axis. The security market line applies to individual assets and portfolios and uses beta. Mixing those two lines is a classic exam error, and more importantly, a sign that the risk measure has not been matched to the question. Third, you should be able to connect an index model to regression output. The intercept is an estimated alpha, the slope is beta, and the residual captures the part of return not explained by the market index. Historical estimates are noisy. The selected benchmark, time period, return frequency, and changing business mix can all alter the result. Fourth, you should be able to compare CAPM with multi-factor models and arbitrage pricing theory. A multi-factor model can describe several systematic sources of return such as size, value, momentum, interest rates, or credit. The added detail may improve fit, but it also creates more choices and more opportunities to confuse an explanation with an investment edge. The assessment focus is application, interpretation, and judgment. A strong answer should calculate correctly, explain the economic mechanism, identify the model assumption, and state what could make the conclusion wrong. A formula without interpretation is only half an answer. A confident forecast without a risk model is the other half. And unfortunately, those two halves do not make a whole. The chapter is organized around 4 connected questions. The first question is CAPM equilibrium. Under the model's assumptions, all investors identify the same optimal risky portfolio, which is the market portfolio. They then combine that portfolio with the risk-free asset according to their risk tolerance. This is the mutual fund theorem. One common risky fund can serve investors with very different preferences because the difference appears in the amount allocated to the risk-free asset. The second question is beta. Beta measures an asset sensitivity to market excess return. More precisely, it reflects the asset's covariance with the market divided by the market's variance. That is why beta is not the same as volatility. A stock can be wildly volatile for company-specific reasons and still add less systematic risk than a steadier cyclical stock. The third question is the security market line. The SML converts beta into a required expected return. Its intercept is the risk-free rate, and its slope is the expected market risk premium. A forecast above the line implies positive expected alpha. A forecast below the line implies negative expected alpha, assuming the model and inputs are appropriate. The fourth question is APT and factor models. These approaches recognize that market beta may not be the only systematic exposure investors care about. Inflation, rates, credit, size, value, momentum, and other factors can affect diversified portfolios. The sequence matters. Start with the equilibrium logic, identify the risk measure, calculate the required return, and only then discuss alpha or alternative factors. Otherwise, alpha can become a flattering name for whatever the model forgot. The goal is a usable mental model, not a vocabulary list. CAPM gives the baseline. Index models estimate the relationship. Multi-factor models expand the risk description. APT asks what relationships must hold when diversified arbitrage opportunities cannot persist. This slide brings together 6 concepts that students should be able to define and use. The market portfolio contains all risky assets in market value weights. In the pure theory, that means more than a broad stock index. It would include bonds, real estate, private businesses, and other risky claims. In practice, analysts use investable market proxies. That gap matters because beta and alpha are always measured relative to a chosen benchmark. Beta is sensitivity to the market portfolio. A beta of 1 suggests market-like systematic exposure. A beta above 1 suggests greater sensitivity. A beta below 1 suggests less. A negative beta would imply movement opposite the market, although stable negative beta assets are rare and often expensive when everyone wants protection at the same time. The security market line is CAPM's expected return relationship. It prices beta, not total standard deviation. Alpha is the difference between an asset's expected or realized return and the return implied by the model. Be careful with the word alpha. Expected alpha is a forecast. Realized alpha is an estimate after the fact. Neither is a personality trait possessed permanently by a stock or manager. The index model is the regression framework that relates a security's excess return to an index's excess return. The slope estimates beta, the intercept estimates alpha. The residual reflects firm-specific effects and model error. APT is a no arbitrage theory for well-diversified portfolios with multiple systematic factors. It does not hand us one universally accepted list of factors. That flexibility is useful, but it also means factor selection requires judgment. A strong answer names the concept and explains how it changes the decision. Saying that a stock has a beta of 1.3 is descriptive. Explaining that its required return rises more than the market premium and that the estimate depends on the benchmark is analysis. The decimal is not the insight. The economic exposure is. A disciplined asset pricing workflow has 6 stages. Step 1 is choose the benchmark. Select a market index or set of factors that is relevant to the security or portfolio. Benchmark choice is not housekeeping. A U.S. technology stock, an emerging market bank, and a high-yield bond should not automatically be judged against the same single index. A convenient benchmark can manufacture impressive-looking alpha, the way flattering lighting can manufacture a profile picture. Step 2 is estimate beta, or factor exposures. Historical regression is common, but the estimate depends on the sample period, return frequency, outliers, leverage, and changes in the company's business. Betas also tend to move toward the market average over time, so many forecasting methods adjust raw estimates toward one. Step 3 is compute the required return. Under CAPM, combine the risk-free rate, beta, and market risk premium. Under a multi-factor model, add the premiums associated with each estimated exposure. Step 4 is compare the required return with the analyst forecast return. The two numbers answer different questions. Required return is the hurdle implied by the model. Forecast return is the analyst's view of what the investment may deliver. Step 5 is classify expected alpha. Forecast above required return means positive expected alpha. Forecast below required return means negative expected alpha. The word expected is doing important work. Nothing in that comparison guarantees the outcome. Step 6 is review assumptions. Ask whether the benchmark fits, whether beta is stable, whether important factors were omitted, whether the forecast already reflects the same macro view embedded in the model, and whether costs or taxes consume the apparent opportunity. Process discipline prevents the final output from looking more precise than the evidence. An asset pricing model should make assumptions visible. It should not give them better hiding places. The key CAPM relationship is expected return equals the risk-free rate plus beta times the expected market risk premium. The risk-free rate compensates for the time value of money under the model's assumptions. In practice, the selected rate should be consistent with the currency, horizon, and return forecast. Using a short treasury bill rate with a very long horizon nominal forecast may be convenient, but convenience is not the same as consistency. The market risk premium is the expected return of the market above the risk-free rate. It is the slope of the security market line. A larger premium raises the required return for every asset with positive beta. Beta determines how much of that premium applies to the asset. A beta of 0 produces a required return equal to the risk-free rate. A beta of 1 produces the market's expected return. A beta of 1.3 produces a risk premium 30% larger than the market premium. That does not mean the stock will rise 30% more than the market in every period. Beta is an expected sensitivity, not a coupon printed on the share certificate. Alpha is the residual after the model implied return is accounted for. If CAPM says an asset requires 10% and the analyst forecasts 12%, the expected alpha is 2 percentage points. The forecast could still be wrong, the beta could be unstable, or the benchmark could omit a relevant factor. Also, keep the capital market line and security market line separate. The CML evaluates efficient portfolios using total volatility. The SML evaluates assets and portfolios using beta. One asks about the best complete risk-return combinations. The other asks whether expected return is adequate for systematic risk. Before using the formula, explain the units and direction. Rates are percentages. Beta has no units. A higher beta increases required return when the market premium is positive. A beta without a benchmark is like a speedometer without a car. The number is real, but the interpretation is missing. CAPM and multi-factor models solve related but different problems. CAPM uses one systematic factor, the market portfolio. Its strengths are clarity, a direct economic story, and an easy benchmark for required return. It tells us why diversifiable risk should not command an expected premium, and why beta matters in a well-diversified portfolio. Its weakness is that the real world does not cooperate with all of its assumptions. Multi-factor models allow several systematic exposures. A stock might have market beta plus sensitivity to size, value, momentum, profitability, investment, interest rates, credit, or industry conditions. These models often describe realized returns better because two securities with the same market beta can behave very differently when inflation, rates, or factor leadership changes. Consider 2022. Many long-duration growth stocks and energy companies could have similar broad market beta estimates from an earlier period, yet higher rates and inflation affected them in opposite ways. A single beta was not useless, but it was incomplete. The factor story helped explain why. Arbitrage pricing theory approaches the problem through no arbitrage rather than CAPM's full equilibrium assumptions. In a large market, well-diversified portfolios with the same factor exposures should not offer persistently different expected returns without attracting arbitrage capital. A PT is flexible about the factors, which is both an advantage and a responsibility. More factors are not automatically better. A model can explain yesterday with 20 variables and still be useless tomorrow. Factors can be data mined, crowded, unstable, expensive to trade, or difficult to interpret. A better empirical fit can simply be a better rear view mirror. The right model depends on the job. CAPM may be sufficient for a teaching benchmark, a rough cost of equity estimate, or a first pass performance hurdle. A multi-factor model may be better for attribution, portfolio construction, or diagnosing hidden exposures. The question is not which model sounds more sophisticated. The question is which model improves the decision without pretending uncertainty disappeared. Modern portfolio analysis rarely stops at one beta. Risk systems now decompose portfolios into market sector, style, rate, credit, currency, volatility, and sometimes liquidity exposures. That change reflects better data, more computing power, and a market filled with factor-based funds and derivatives. What changed? Analysts can estimate exposures faster and at greater detail. An equity portfolio can be described not only by market beta, but also by size, value, momentum, quality, industry concentration, and sensitivity to interest rates. A bond portfolio can be decomposed by duration, curve, credit spread, and liquidity. The dashboard became richer. What stayed the same? Models remain estimates built from historical relationships. Beta can change when a company changes leverage, business mix, or economic sensitivity. During the 2020 pandemic shock, travel and leisure companies suddenly behaved like highly cyclical options on reopening. A beta estimated from a calm pre-pandemic window was not carved into granite. It was an old photograph. Who benefits? Portfolio managers can see whether apparent stock picking alpha is actually a factor tilt. Risk officers can identify concentration that is hidden across many holdings. Corporate analysts can use systematic risk estimates when setting hurdle rates. Investors can compare managers with a more honest understanding of what drove return, what risk remains. Model risk, estimation error, crowding, nonlinear payoffs, liquidity shocks, and regime changes remain. A low beta portfolio can still lose money. A factor-neutral portfolio can still have security-specific mistakes. An option strategy can have risks that a linear beta does not capture. CAPM remains valuable because it supplies the baseline question: what systematic risk is being added and what return should compensate for it? Multi-factor tools improve the description, but they do not repeal uncertainty. A risk report with 6 decimal places is still a risk report, not a witness from the future. Now apply the framework to the practice case. The stock has a beta of 1.3. The risk-free rate is 4%, and the expected market risk premium is 6%. CAPM required return equals 4% plus 1.3 times 6%. 1.3 times 6 is 7.8. Add the 4% risk-free rate, and the CAPM required return is 11.8%. The analyst forecast a 13% expected return. Subtract the 11.8% required return from the 13% forecast. The result is positive expected alpha of 1.2 percentage points. Pause here and notice the wording. This is not a guaranteed 1.2% bonus. It is the gap between one forecast and one model implied hurdle. The analyst could be too optimistic. The beta estimate could be stale. The market risk premium could be wrong. Or the stock could have factor exposures that CAPM does not capture. Why is firm-specific risk not rewarded in CAPM? Because a diversified investor can reduce that risk by holding many securities. The market should not have to pay an expected premium for a risk that investors can avoid at low cost. Systematic risk remains because it affects many assets at the same time. What factor might a multi-factor model add? Reasonable answers include size, value, momentum, profitability, quality, or an industry factor. The best choice depends on the company. A small, rapidly growing technology stock may have size and growth exposure, but a highly levered bank may require interest rate and credit sensitivity. Do not add a factor merely because the regression software offers a button. The recommendation should include the evidence and the trade-off. The case suggests positive expected alpha under CAPM, but the conclusion depends on the quality of the 13% forecast, the relevance of the benchmark, and the stability of beta. The arithmetic is clean, the investment decision is not. Finance likes to hide judgment immediately after the equal sign. This slide highlights 5 common mistakes. Mistake 1 is treating beta as a permanent fact. Beta is an estimate. It can change with leverage, product mix, customer base, industry conditions, and the market regime. A retailer can become more cyclical after taking on debt. A technology company can become less sensitive as recurring revenue grows. Beta is not tattooed on the stock certificate. Mistake 2 is calling any high return alpha. A stock that rises 40% during a broad risk-on rally may simply have high beta or strong exposure to a rewarded factor. Alpha is return relative to a model, not a synonym for an exciting chart. Mistake 3 is using CAPM without checking benchmark relevance. An emerging market company measured against a narrow U.S. index may produce an alpha estimate that mainly reflects currency, country, or sector mismatch. The regression will still produce a number. Spreadsheets are wonderfully polite that way. Mistake 4 is ignoring mean reversion and estimation error in beta. Historical betas often move toward 1, and extreme estimates may contain noise. The confidence interval can be as important as the point estimate, although it is far less popular in marketing materials. And mistake 5 is assuming multi-factor models eliminate uncertainty. They can explain more dimensions of return, but they also create factor choice risk, data mining risk, and the possibility that factor premiums change. Additional warning signs include confusing the capital market line with the security market line, mixing expected and realized return, treating statistically insignificant alpha as proof of skill, and forgetting fees and trading costs. A good analyst uses the model as a disciplined challenge to the thesis. Ask what benchmark fits, which period was estimated, what factor is omitted, and what would change the conclusion. The model should reduce sloppy thinking. It should not give sloppy thinking a Greek letter. Here's the knowledge check. In CAPM, which risk measure determines a security's expected risk premium? A, beta, B, total variance, C, book value, D, dividend yield. Pause for a moment and choose before continuing. The correct answer is A, beta. Beta measures the security's contribution to systematic market risk. Total variance includes both systematic and firm-specific components. CAPM does not reward the firm-specific part because a diversified investor can reduce it by holding many securities. Book value may matter in valuation or in a value factor model, but it is not CAPM's risk measure. Dividend yield may contribute to total return or signal characteristics of the company, but it does not determine the CAPM risk premium either. One more distinction is useful. A beta of 1.5 does not mean the stock must earn 50% more total return than the market every year. It means the model assigns the stock a market risk premium that is 50% larger than the market premium. If the risk-free rate is 4% and the market premium is 6%, a beta of 1.5 produces a required return of 13%, 4 plus 9. CAPM is an expected return model. Realized returns can be very different over any particular period. A company can deliver good news, bad news, or simply weird news. Beta sets the hurdle for systematic risk. It does not write the next earnings release. The key retrieval point is simple. CAPM prices beta. Total volatility belongs elsewhere in the analysis, especially when the investor is not well diversified or when we are evaluating a complete portfolio rather than an individual security. Let's close with 3 takeaways. First, CAPM prices systematic risk, not total risk. Diversification reduces firm-specific risk, so expected return is linked to the risk that remains in a broad portfolio. Beta is the model's measure of that systematic sensitivity. Second, alpha is model dependent. A security can show positive alpha against one benchmark and no alpha against a better factor model. Expected alpha also depends on the analyst's forecast, while realized alpha depends on the measurement period and statistical noise. Alpha is not an object we discover under the couch. It is a conclusion produced by assumptions and evidence. Third, multi-factor models can improve description, attribution, and risk control, but they introduce specification choices. Which factors belong? Which data window is appropriate? Are the premiums stable? Can the exposures be traded economically? Additional detail is valuable only when it helps answer the investment question. After the slides, the homework asks students to calculate CAPM required return and write a short alpha memo. The discussion asks whether beta is enough. The quiz checks the market portfolio, beta, the security market line, index models, alpha, mean reversion, multi-factor models, and APT. This chapter also sets up Chapter 8 on the efficient market hypothesis. CAPM gives us a benchmark for expected return. Market efficiency asks whether information can be used to earn abnormal return after risk and cost. If positive alpha were obvious, permanent, and free to capture, competition would have a very short meeting with it. Finish by asking, what would change my recommendation? A different beta, a different market premium, a benchmark that better matches the company, a factor exposure that explains the apparent alpha, a forecast with weaker evidence. CAPM is not the final word on expected return. It is the first disciplined sentence. Use it to establish the hurdle, then decide whether the additional complexity of a multi-factor model actually improves the decision.